Hi everyone, this is I'm Stuck and welcome back to our history series on America 1920 to 1973. Today we'll be explaining the stock market and speculation which made some Americans extremely rich in the 1920s. Before we can understand what went wrong in 1929, we actually need to understand how the stock market works. Think of it this way: when someone starts a business, they need money to get it going. They might need to cash to buy equipment or machinery, pay workers' wages, purchase raw materials, or rent or buy buildings. Some business owners are wealthy enough to use their own money, but most need to borrow from investors. Instead of just lending money, investors can buy shares in the company. Each share represents a tiny piece of ownership. If you own shares in a company, you're called a shareholder. As a shareholder, you receive dividends, which are a share of the company's profit paid out annually, and capital gains if the company becomes more valuable and your shares increase in price. Shares are bought and sold at a stock exchange, the most famous being the New York Stock Exchange on Wall Street. In the 1920s, this was where fortunes were made and lost daily. Here's how it works. Companies would go public by offering shares for sale. Investors would buy the shares through stockbrokers, and share prices would rise and fall based on supply and demand. If lots of people wanted to buy a company's shares, the price went up. If people wanted to sell, the price went down. During the economic boom of the 1920s, American companies were making record profits. This made their shares more valuable for several reasons. Higher profits meant bigger dividend payments to shareholders. Business expansion meant companies were worth more. New technologies created entirely new industries with huge potential, and consumer demand was growing rapidly. Between 1920 and 1929, the average price of shares increased by 300%. Some individual companies saw even bigger gains. For example, the Radio Corporation of America shares rose from $85 to $420 between 1928 and 1929. Now let's look at stock market speculation. As share prices kept rising, something dangerous was beginning to happen. People stopped investing based on a company's actual value and started speculating, essentially gambling that prices were going to keep going up. The stock market boom wasn't just for the wealthy. By 1929, approximately 1.5 million Americans owned shares. This included middle-class professionals, small business owners, and even some factory workers. Many people saw the stock market as a get-rich-quick scheme, and newspapers and magazines were full of stories about ordinary people making fortunes. The media encouraged this with headlines like "Everyone ought to be rich" and "Wall Street, the new gold rush." The most dangerous aspect of the 1920s speculation was buying on the margin. Essentially buying shares with borrowed money. Here's how it worked. An investor might want to buy $1,000 worth of shares, but instead of paying the full amount, they would pay only 10%, so $100, as a deposit. The stockbroker would then lend them the remaining $900, and if the share price rose to $1,200, the investor could sell and repay the $900 loan and keep the $200 profit. But there was a huge risk. If the share prices fell below a certain level, the broker would demand immediate repayment. This was called a margin call. Investors who couldn't pay would then be forced to sell the shares at a loss, and many people would lose everything they had invested. By 1929, it's estimated that $8.5 billion worth of shares had been bought on the margin, which is roughly $125 billion in today's money. So the Republican government's laissez-faire approach meant there were virtually no regulations on controlling stock market speculation. There were no limits on margin buying, no requirements for companies to provide accurate financial information, no oversight of stockbrokers' lending practices, and President Coolidge actively encouraged speculation, saying it showed American prosperity. This lack of regulation allowed the speculative bubble to grow larger and more dangerous, eventually leading to the 1929 crash, which we will look at later in this series. That's it for this video. If you found it helpful, please consider liking and subscribing, and see you in the next video where we'll be looking at the inequalities of wealth in the 1920s.